welcome to another Phia Group Empowering Plans webinar. I am your host, Adam Russo. Oh, wait, co-host. What am I doing, Ron? I'm pretending that I'm the only one here. I'm surrounded by these great people, and I just act like I'm the only one.
You're hosting us, Adam.
That is true. I'm the main host. No, kidding. I'm your co-host, CEO and co-founder of the Phia Group. My name is Adam Russo. With me, as always, my Senior VP and General Counsel, Ron Peck. Say hello, Ron.
Hello, Ron.
Next, my other VP of Phia Group Consulting. She's not as cool as Ron, but she's a lot smarter. Say hello to Jen McCormick. Say hello, Jen.
Hello.
She always says a hello. She can't just follow the rules.
Yeah.
Why doesn't she just do what everyone else does?
Too much respect for my intellectual property.
She is not a Phia groupie. Every Phia groupie we meet, when we say hello to them, they go, hello, and they say their name. Every time. And then last but certainly least, our good friend, our latest addition to the webinar team, a mainstay on our podcast programs. Say hello to our DC insider, just back from Singapore. Say hello to Brady Bizzaro. Say hello, Brady.
It's a long night. Hello, Brady.
Long night. Folks, we're on a good mood because it's 74 degrees outside. It's 72 degrees inside. It's just beautiful, right? This is the weather that we all wait for basically for 6 months. We sit around from October till now, looking forward to days like today. It's going to be through the 80s, I think, until next week at this time. You know, some of us have to work. Others, like Jen McCormick, decide to go away to an island for a couple of days. Not all of us have that ability, luxury.
I'm sure she'll be checking her emails from the room.
From the room? From the beach?
From the beach.
I really doubt that. But you know what? Everyone on this webinar, please email Jen McCormick on Thursday or Friday. Pretend that it's an urgent message to see what happens. Let's see if she responds.
I like it.
Folks, just want a couple announcements. One is we're really excited. We are now going to be starting doing our video podcast. I think next week we're actually starting. Yep. Later this week, Ron Peck and I will be and Brady will be decorating our new podcast room so you can see all of our paraphernalia. You'll have, I guess, photos of Reagan, maybe Nancy and Ron from Brady. You'll have some Patriots Gronkowski photos with Ron.
There you go.
You'll have some Cleveland Indians, racist, stereotypical logo stuff.
Tim Tebow in a Mets jersey.
Yeah, we'll have some stuff from the Indians as well, but we're really looking forward to having those podcasts videotaped starting next week. And obviously, we're going to focus on what you ask about today. So it's important that you keep those questions coming. Just like last month, we're having record numbers again this month. We want to thank Matthew Paynton, our now client account. You're a client account manager now, right? He has moved up from just being the podcast, I'm the Twitter guy, to now being our client account manager. So I want to give him a kudos for helping these numbers increase. So what are we talking about today? Pretty simple, finger pointing. So everyone here, well, Brady, you don't have any kids, right?
Not yet.
Ron has just one, so we can't use Ron as an example. Jen's sort of, getting there, right? So I can tell you that finger pointing starts at a very young age. It does not take a long time for the kids to start pointing fingers at each other as to who's to blame. I mean, literally yesterday, I saw there was like chips on the ground. So I asked Maeve, why'd you leave the chips there? Oh, no. Solely took the bag and dumped them out on the floor and left them there. I'm like, oh, so you're blaming your sister? Yeah, it's her fault. She's bad. So that's it. We're talking about a 4-year-old. So finger pointing starts at a very young age, and obviously it happens when you're in your 40s, 50s, and 60s as well. So today we're going to talk about the various examples of finger pointing that we see in our industry. There are lots of examples. You'll all probably understand and recognize one of them as being something that you've experienced yourself. And if you'll notice, a lot of the services that we have relate result from actual finger pointing. Paste being the perfect example of that particular service. So today's speakers, you know the four of us, those dashingly good-looking folks, except for the bottom right. Next, make sure you follow us on LinkedIn. Here's what we know. We did a recent survey of our clients, and the number one thing that our clients told us they would improve the Phia Group, and overwhelmingly it was to replace Brady. I have proof of that. This is not videotaped. If it was, you'd all see. I'm actually showing the proof that replacing Brady was by far the number one attribute.
Tom Brady, I think they meant.
But the reason I bring this up is, here's what we know. 83% of you are following us on LinkedIn. That means 17% of you aren't. And that's the reason why Matt has not gotten a raise in all this time. So for those 17% of you who have not followed us on LinkedIn yet, please feel free to do so now. All right, as you know, we're very proud of the fact that we are the best health plan, the best self-funded health plan for any employer under 250 lives. We're going to have this slide up for the next 20 years. We'll go to the next one. Our Phia certification, as you all know, we have a bunch of people that have already taken it, level 1. We have people passing it. We got a bunch of people failing it.
Yeah.
Hopefully they start to pass it. I want to give Hannah kudos for helping Ron, Peck, myself design this great program. We are now going to be working on level 2 certification. Ron doesn't even know that yet, but we have a meeting scheduled this week to talk about what those topics should be. So for those of you out there who keep on asking, no matter how much you're willing to pay us, we are not ready to offer Phia certification to the general public at large. We need to make sure that we fix all the kinks first here internally before we can start offering it to the outside world. As always, the lovely, the smart, the amazing Jen McCormick is going to focus on what the Phia Group Consulting's most frequently asked questions were over the past 30 days. Jen, I'm turning it over to you.
All right, here we go. Dig right in. Question number 1. So what do I need to know about the state law requirements for self-funded student health plans or state assessments of self-funded plans? So issue number 1 here, when we're talking about state law requirements, is a reminder that when it comes to certain types of plans, like a governmental type of plan or a church plan, they're not subject to ERISA. So, meaning that they are not exempt from certain state laws. So as a governmental type plan or a school plan or a university that is sponsored by a governmental entity, that means with their exemption from ERISA or not being subject to ERISA, that there are potentially going to be mandated benefits or other particular state laws that those student health plans are going to have to be subject to. So the suggestion there is to take a look at the entity that is actually sponsoring that self-funded student plan, confirm whether it actually is a governmental entity, and if so, look where that plan is established in the particular state law requirements, benefit coverage assessments within that particular state. Number 2, does the ACA require a health plan to cover disabled children over the age of 26? The answer, no. ACA does not require a health plan to cover disabled children over the age of 26. ACA doesn't actually require coverage of any individuals. It's only that you could be penalized for not doing so. So the thing to make sure that you note here is that in April of 2018, they actually modified and updated the claims procedures for disability-type claims. So if there is a particular plan that is making the decision because they want to or because they want to stay as fluid as the rest of the plans that are potentially in that state or subject to state laws, offering coverage for those who are beyond the age of 26, are there certain rules or requirements they have to abide by if someone is being denied coverage due to a disability? If they are being denied coverage due to a disability, make sure that the procedures and claims processes that you're using are in line with those new April 1st, 2018 rules and regulations. Number 3, for PHI purposes, what is the relevance of legal custodianship of minor children? So this is an interesting question. So as a parent, this is something that I've learned myself. Just because you are a parent doesn't mean that you are automatically entitled to the PHI for your children. But only if you are the personal representative for your minor child does that mean that you have the right to access that PHI. Most parents do have that relationship. However, there's a possibility that maybe there's some sort of state law that could prohibit the disclosure of the PHI to that individual. Maybe there's a custody agreement, or maybe the records are related to a sexual assault or psychiatric records. So the answer is, first you have to look at who the personal representative is of that actual minor child. 2, take a deeper look at that state law. Is there anything that would prohibit the disclosure in that particular case based on those facts? Number 4, am I required to provide a translated SPD? This is a Phia certification question, so listen closely. The answer to this question is no. You are not required to provide a translated written SPD to the actual plan participants.
So what if a person can't read English?
So there are certain requirements based on a percentage. There's a formula based on whether you have more than 100 or fewer than 100 participants in the plan. And based on that, if there is a 10% of the population is literate in the same non-English language, then you're required to provide oral assistance. So if someone is calling in, they need assistance, you're required to actually help them with the translator or provide
Should we
assistance.
put this in real numbers? So let's say the Phia Group self-funded plan. We have 200 people. If we had 20 people who all spoke Portuguese, at that point in time, we still wouldn't need a translated SPD. It's 10% of the population. We'd have to have oral assistance.
So there needs to be some sort of translator that someone can talk to, or one of those phone services they can call in.
So we got to have someone's mother come in here who speaks English and Portuguese and translate the SPD to Brady, for example, and explain to him what the SPD says.
So there are certain qualifications and certification requirements that have to be met. And
by the translator.
By the translator. So there are certain requirements that have to be met.
This is level 2 type question now.
And also there are certain notice requirements that have to be addressed to and potentially translated.
But I was going to say, you see this, Hannah? You see this, Ron? Like, this is level 2 now, right? Level 1 is, do you have to be, do you have to have translated SPD? No. But then you have the example of a situation, and now someone's mom wouldn't be good enough unless they met some type of requirement. Makes sense.
Right.
Question back on the PHI purposes. One of the things I've always seen, and we have, again, full transparency here at the Phia Group, right? We have some clients who don't allow us to send letters to the parent regarding their son's or daughter's claims, even though they're the parent, they're the member, right? Because of PHI issues, other clients that feel it's okay to send that information. What's our take on this?
Yeah, so I think the thing you have to consider is a case-by-case analysis and what are the types of claims at issue. So in certain states, there's regulations, particularly for teenagers as they're getting older, and maybe there are certain types of claims that maybe their parents don't necessarily want to know about right now.
Like an STD?
Or pregnancy.
Right.
Or abortion.
Yep. Like those kinds of claims.
Right.
Let's just say it.
Right.
It's okay.
So when it comes to those types of claims, that's why I think that people have kind of taken this stance. But the threshold question is, are you the personal representative for that particular minor child?
Yes.
So
I'm the dad. Again, I'm 10 years away, hopefully, from any of these things, right? But I might open a letter that says, XYZ, your daughter went in for some type of procedure, and I'm not very happy about it.
Right.
That happens, I'm assuming.
Mm-hmm.
So it depends on the law, because that's the type of stuff that I think many of our clients are so used to doing it. Here's another thing, where we talk about fiduciary duty and breaches. So many of our clients are just used to sending the parent a letter relating to their children's claims. The thought never crossed their mind that it needs to change. They need to change a process.
Another thing, Adam, when you talk about these processes and procedures that were already in place, for a long time, many of these plans, you were allowed to be on your parents' plan to age 18.
Now it's 26.
Bingo. So what happened was they had built their system so that this person was a quote-unquote minor child until they became an adult. They never had to deal with a situation where the plan member's child is an adult, because when they were an adult, they were no longer on the plan. Change in law, they didn't change their process.
Great.
So if you have any specific questions about PHI or disclosure or HIPAA, you can always reach out to PGC.
And make sure you do it also CC Jen McCormick personally on Thursday or Friday of this week while she's on her PTO days. Good. Next, what we're going to focus on today, problem, purpose, people. Obviously, we're going to have the political update with Brady Bizzarro. Brady will give us all the North Korean news that we need to hear about. Can't wait. Last but not least, the focus of this webinar, the blame game. And we're all going to go around and we're going to pick who is to blame. That's one of the things I want to add on to this, is we each will pick who we think is to blame for a particular scenario. So, as we talked about, our industry is getting old. We want young people like Jen McCormick to join our company, to join our industry. How do we do that? Millennials care about what? Having a purpose. Why am I here? How am I bettering the world? You don't have to even pay them. They don't care about money. What they care about is making the world a better place. So what is our purpose? We want to tell those millennials that hardworking Americans deserve access to high-quality, affordable health care, and they can help us do that. So, with that, the winner is what? What is this? What is this slide? I'm not getting this at all. Brady?
So thanks, Adam. So this is, I just wanted to make a little announcement about, we don't know who it is yet, but in 2 weeks, we'll know who the CEO of this joint venture is.
Are you leaving us, Brady?
That might be what's inside the truck. It could be my new little suite I have in there as they drive me away.
Is that like a big couch, like a leather couch?
It's just driving me out.
By the way, folks, just so you know, I know that Brady's getting big. He's getting very cocky. I don't know if you guys noticed his head is getting bigger and bigger every week. Especially after last week when he met so many of our clients, tell Brady how great he is in the podcast, what great legal opinions he does. Folks, Brady's been telling us how we have to keep on giving him more money because he'll leave. We know he's not leaving. So keep offering him his jobs. He's not leaving the office. We will shoot to kill Brady if he tries to leave Phia. So that make sure everyone knows that. Have that on your conscience. Brady, you're not going anywhere.
All right.
Make sure you're aware of that. I don't care if you're the next CEO. Go ahead.
So we know who that is. We'll let you guys know in 2 weeks, or I'm sure you'll hear yourself. But I thought it was interesting to know that Warren Buffett is the one who sort of made the decision there. Okay, so what's going on in politics? It is true that I was up watching the summit last night, but unfortunately, that's not the subject of today's webinar. Maybe a podcast will do. But there is some big news to talk about, and one of the things that's happened recently, you might recall from a few webinars previous, we talked about a lawsuit that was filed against the federal government by 20 states, led by Texas, that was challenging the Affordable Care Act. It's not the first time this has happened. There's been many lawsuits. Of course, we all know the primary one that upheld the law back in 2012, but since then there's been, or 2010 rather, since then there's been a bunch of other lawsuits. This one was notable because it was interesting. The Attorney General of Texas was making the argument essentially that with the individual mandate essentially repealed because you don't have a penalty in place, that the rest of the law has to go. So it's kind of a leap of logic there, but they cleverly used the Chief Justice of the Supreme Court's own words when they made this argument, saying the only way you could force people to buy insurance was through a tax penalty. But now, if you don't have the penalty, you arguably don't have a tax at all. So the mandate itself, they're arguing, has been effectively canceled out, and that's, in their view, such an important part of the law that the whole ACA has to go. What's new now in June is that the Department of Justice wrote a brief to a federal court saying that it agrees with these 20 conservative states, that they do think that major parts of the ACA are now unconstitutional because of congressional action last year to repeal or effectively repeal the individual mandate. So that's a big deal. If the federal court there agrees with DOJ, then big rules like the ban on differential treatment of people with different conditions, that would go away.
Give me an example. I mean, a decision expected this summer. We obviously know your opinion is going to be that what?
Yeah, so we want me to prognosticate, which is often I'm usually wrong at doing, but I would be surprised if I don't think the court's going to side with the DOJ in this case. If it goes to the Supreme Court, it might, because now you've got an extra conservative there who could be a tiebreaker and has already been doing that on big cases.
So you believe that the court will not agree, therefore it's status quo?
Exactly. I do think that's going to stand. I think I would be surprised.
But if the DOJ and the court agree, what's the number one thing that's going to be affected by our self-funded plans?
Well, the entire ACA essentially would be gone. So plan design,
no longer
essential health benefits. You don't need to comply with those
preventive pre-existing conditions.
Lifetime limits could come back.
So literally, every plan. So Jen, I guess get the vacation in now. Every plan could be altered if people said, you know what, $1 million limit.
I'll just find a 2009 plan document and put that back into effect.
I was literally take your 2009 plan, put it back in.
You save copies.
Right. Got it. That's a big deal. So I'd be shocked if they're willing to do that, because it would really be
I'm assuming we'll have a webinar on this.
Yeah.
This would be a webinar topic. Unless,
it totally could be. Yeah.
But if the court, I mean, if they don't agree, obviously we're not going to have a webinar toward that nothing's changed, right?
Right. But if they don't agree, it's still notable that the administration is not defending the ACA in court anymore. So the more these lawsuits are brought by conservative states, the more we're chipping away at different pieces of, it could be the employer mandate next. For Democrats and other policymakers who believe in the ACA, they should know that this administration is not going to defend major parts of it, and that's a big deal.
Good.
So what else is going on? I wrote a blog post about this. This is on our website. Feel free to read for more details. But basically, a couple new states have enacted their own individual mandates, copying Massachusetts, of course, and we had mentioned previously a couple of ideas that were out there. These states have actually acted. New Jersey, the governor there is a Democrat, Phil Murphy. He signed into law their own mandate. It's modeled after the ACA's mandate, or what was the mandate, I guess. The penalty amount is the same. In this case, they're using amounts collected to subsidize care for seniors, so that's kind of smart. But they're worried about losing people from the individual market and basically the adverse selection problem where you only have sick people. They're trying to find ways to keep people in the market that are young and healthy. And so New Jersey has done that. Vermont.
Hold on a second there. Jen, in regards to New Jersey, $695.
Mm-hmm.
Like, I don't know, is that per family, per person? Do we know?
Per person.
Yeah, so, and it's also, there's a threshold that's based on your income too. So it could fluctuate.
All right, let's say I'm making, let's say I'm Brady. I'm making, $500,000 a year, right? and I just don't feel like getting insurance. I pay $700.
No,
No, you'll
it's
pay-
the greater of.
Right, so you'll pay 2.5.
That's in the blog
All right.
details.
So let's now make it $100,000.
Right.
So Brady's paying $2.5 grand penalty. It's still,
It's not, I don't think, enough to push someone over the line. If you're
but it's close there. If he's making $100,000, that's $2.5 grand. You can get an individual policy. I'm assuming for pretty cheap, right, Brady?
Maybe like 1,500 or 1,700 or something like that.
Yeah. So I mean, it's pretty close there.
I think they're hoping there are enough people who are wavering on the line that this is enough to push them over the edge.
Right, it's
Got
about incentives, really.
Got
So Vermont, also, their mandate will go into effect in 2020. They have not yet set their penalty amount. They have a working group commission. But what's notable there, obviously, it's funny how many, fewer residents Vermont has in New Jersey, so not as big a problem as New Jersey may have. The governor of Vermont is a Republican, which Vermont's kind of weird. Basically, he's a Democrat because it's Vermont, but he is a Republican, and yet he signed into law an individual mandate. So that's notable. Other
Romney
states
did too. He was Republican.
Well, right. I'm just saying, given the state of things today, there's other states that are considering mandates.
Political wonk here. Obviously, because it's not the first time.
Right.
So we'll see what happens with
In fact,
that.
they invented it, huh?
They did. There are a bunch of other states considering this, and they're all worried about the same problem, which is rising healthcare costs, which we're all worried about. So, with that is the political update. We're also watching for the final rules on association health plans. When we find out what they are, we'll make sure that we bring those to light as well.
Speaking of associate health plans, so obviously, if you ask me, I know it's not a PTC issue. The number one most asked question coming to the CEO, to myself, or to our leadership team is definitely, how will association health plans affect our industry going forward?
Mm-hmm.
So, Brady, I know there's the expected decision or something happening soon, right?
Yep, the proposed rules will be finalized and published, and we can see exactly what.
Do we know when that's going to be?
It's supposed to be this month.
So I think,
government, they're slow.
I know that we usually wait till the last slide, but our next webinar will be July 12th. I'm assuming that by July 12th, if this comes out, we should be able to do a quick one-day powwow and get as much as we can on this, right?
Definitely, unless it gets delayed, which is.
Because I believe that this is probably either A, the best thing that's ever happened to self-funding, or potentially the worst thing that's ever happened to self-funding.
Right.
Depends on who you talk to and who you work with. But association health plans, by far, are going to be a big thing.
Cool. So, yeah, we'll have a lot more to say about that. So, on to the blame game. The first slides that I have the pleasure of presenting on are blaming stop-loss carriers and stop-loss issues. And just as a quick refresher, we want to go over again what we mean by hard gaps and soft gaps. We hear about them a lot, but it's really worth making sure you know exactly what we mean when we use these terms. And so for hard gap, what we're talking about is literally different language. For two different documents, the plan document and the stop-loss policy itself will have either different language, or you'll have terms that are missing from one that are in another, where the result is you literally have a hard gap in coverage. So as a few examples, the one I've provided here is that where you have an exclusion in the plan document for amounts above what is generally billed by a provider, and the stop-loss policy excludes anything over 150 of Medicare. So you're going to have a lot of claims, obviously, that are covered by one and not by the other. That's a big problem. A few other common areas where this comes up will be, for example, treatment outside the U.S. Sometimes you'll have an exclusion which will say if you travel for the purpose of obtaining treatment, not covered. Sometimes you'll just say it'll cover emergency treatment overseas only. That's a hard gap example. Another one is workers' comp, where you may have a plan document that has an exclusion for workers' comp that says if the member elects coverage and it was available, we won't pay claims. The policy might say we don't care whether there was one available. We're excluding all claims. Those are all hard gaps.
But folks, right, these are easy. Let's be honest. This is just laziness. If you can't identify a hard gap, it means you're not reading the policy.
Right.
Either you're not reading it or have someone in your office read it. So if I have one plan that says we're going to exclude anything over 150, and your plan doc says another thing, that's on you, right? We're gonna blame it. I'm gonna blame it on whoever approved that plan, whoever approved that stop loss policy being signed. That's a pretty simple, easy to identify who's to blame here, but unfortunately we see a lot of these.
We do. Yeah.
In my opinion, it's the next one that really is the one that's tough to figure out who to blame, and that's a soft gap.
Yeah.
Go ahead.
And so, yeah, that's the one that, you can be as careful as you can be, and you can still not solve this problem. And this is the gap where you have a different interpretation of the same language. So you could literally have verbatim the same words, and two different entities are interpreting those words differently. So we use an example here, usual and customary. That's a very common one, where you will have different parameters that are taken into account by the plan, and then different ones used by the carrier, and they're interpreting. It could be the same language, just differently.
Okay, let's use a real life example.
Sure.
The exact same definition for usual and customary, or the exact same definition, the more traditional UNC, but now it's more reasonable, let's say reasonable and customary. If I went to two different audit firms, two different audit firms are going to tell me two different prices as to what's reasonable for that particular facility.
Right.
One says 100,000, stop loss says 80. So that stop loss carrier now is reimbursing $20,000 left. Who's to blame? That's the question.
Sure.
And I'm looking at all three of you, and no one's giving me an answer because I don't think any of you know. Because that one really is the broker to blame for not identifying and asking the question, hey, you guys have the same language. Are you allowing the plan to interpret that provision, or do you have the right as the carrier to interpret that provision since you have your own definition?
Right.
Ron?
So Adam and Brady, and I know I think on the next slide you have another example of this type of situation, but one of the things that I know we see a lot lately are that stop loss carriers will say that their policy mirrors the plan, or a broker will ask that the policy mirror the plan. And so people marketing that concept, that term, mirroring the plan, that really, I think, just closes the hard gaps, Adam. My concern is that if a carrier tells you, oh, yeah, we mirror the plan, have you actually done your job? I don't think you have until you've actually asked how they're going to interpret, who has deference, who gets to control how the language is interpreted.
Well, here's the problem. Our audience will disagree with that because our audience, when we polled them, 65% of our audience say they wish that all stop-loss carriers mirrored the plan.
I don't think they necessarily understand what that means.
Are you telling me that the audience is stupid, Ron?
65% of them.
So two-thirds of the people listening don't know what they're talking about? That's what you're telling me.
I think that there's a misconception that the term to mirror the plan not only means to match the language, but to also match the interpretation.
Right.
And I think that's a major concern. And I know that, for instance, one of the examples had to do with illegal acts where they're talking about misdemeanors versus felonies. And we talk about stuff like that. But if it just says illegal acts both across the board, they could have different definitions of the same language.
To get back to RNC. So we're getting a bunch of comments saying, is there a nationally recognized RNC? Is there a set number? No. That's why everyone ties everything to Medicare.
Right.
Because Medicare is the only publicly available where everyone can look at and see what is the Medicare rate for this procedure at this facility.
Right.
But the next comment I get is, well, is it 130? Is it 300? Folks, we've seen everything. We've seen claims paid at 80% of Medicare would sign off, and others paid at 800% of Medicare at the same facility would sign off. And in both situations, someone was happy.
Right.
So, I don't think it's easy for us to say there's a uniform RNC number, but there's definitely a uniform Medicare number. And there's definitely language that would be similar across the board. If you said Medicare plus 140 in the plan, Medicare plus 140 in the stop loss policy, I think you're covered in that situation.
I think one thing that we've worked on in the past, Adam, and then I'll turn it back over to you, Brady, but one thing that we've worked on in the past to kind of close this gap is I think everyone agrees that you're never going to agree 100% of the time on what a certain term means or how it's going to be defined. So instead, what we've worked on, I know in our own flagship plan document, and we've bounced it off of stop-loss carriers in the past, and they helped us come up with this way of thinking, is that instead of mirroring the language itself, what you're mirroring is the methodology that you use to define the word. So what tools you agree are going to be used when defining what the RNC rate is, how you're going to calculate it, what other factors can come into play. So you're not necessarily agreeing up front what it means, but rather how you're going to come up with the definition when the time comes.
So let's go to Brady with the one. This base example is what I call stop loss 101. This is the example that we teach people that first come to Phia of what a gap is. So go with it, Brady. I mean, this is simple, so he'll be able to handle this.
I think so.
So yeah, I mean, essentially, Ron already kind of let the cat out of the bag here, but it's about legal acts. So I mean, we're talking about do you mean to exclude misdemeanors or felonies? Be clear about what you mean to do, because certain offenses, in certain states actually are different depending on what state they're committed in. But if the carrier is intending illegal acts to cover both misdemeanors and felonies, and the plan only wants to cover misdemeanors, then you better be absolutely clear about that, because you're going to have an interpretation problem if you're not.
So Brady, what I realize is people like stories, okay?
Right.
Most people on this call, again, not the 2/3, but there are people, not everyone knows what a misdemeanor is versus a felony. So let's give an example. If I'm drinking and driving, first time in Massachusetts, that's that's knocking on wood, okay? And I hit a stop sign, and the only person hurt is me. It's a misdemeanor.
Correct.
If I'm driving, wasted again, and I hit somebody, and I hurt them, it's a felony.
Correct, sir.
Big difference, misdemeanor and felony. So a lot of times we tell people, oh, if it's a misdemeanor, and they go, well, what's a misdemeanor? Well, a lot of people, when we do audience polls, they don't know that if you're drinking and driving, it's not a felony. They think it is.
Sure.
It's not in many situations. So this is really where you have to, when you talk to your plan, give them that example. And that's a typical example I would share because I think everyone either A, has drove drunk, or B, knows someone that drove drunk. And that's an example where people go, all right, now I understand the difference between a felony and a misdemeanor. But a lot of claims are denied and excluded because of this particular reason.
Sure. And you can even go to the sort of level 2 question where there are certain states that have quirky rules. So if you intend, for example, Georgia, there's certain traffic violations which are actually classified as misdemeanors. So you may not intend to be excluding claims that are traffic violations, but if in Georgia they can charge you with a misdemeanor, you need to know about that. So it can even get more detailed, and you have to be really clear about what you mean.
I would do a search for the word felony. Anytime you find the word felony in your plan, if the plan doc says we're going to deny felony, stop-loss carriers typically deny any illegal act,
Right.
including misdemeanors. It just makes it a lot simpler. So we're getting questions asked about, how do you define intoxication? We wouldn't even define it.
Right.
At the end of the day, there's a lot there, slippery slope, right? Like we hear this all the time. Guys, these are all examples of cases. We can talk about this one issue for 100 hours.
Good. Yeah.
Here's the reality. I'm walking down the street. I'm drunk. If I fell because of my intoxication, you could arguably deny that claim as being excluded if it's intoxication. My injury is due to the result of being intoxicated.
Right.
Versus erring.
Right? But if I'm walking down the street drunk and a rock falls from the sky and hits me on the head, that rock would have hit me on the head regardless if I was drunk or not. Is that claim payable?
Depends on your language.
Right.
So every single time you just need to make sure when it comes to legal acts that your language is perfectly matching what your intent is so you can avoid the situation where someone is pointing finger.
Yeah, and someone's asking too, do we need a conviction for legal acts? These are all things you can put in the plan language and say, whether or not there's a conviction, you can exclude these claims. The standards there, innocent until proven guilty, don't apply to plan sponsors in this context.
Well, typically people say is you have to prove that someone went to jail, right? Do you know how long the process is from the time you're arrested to the time you're convicted? So you'll see how many plan docs we see where it says the arrest of a person is enough. Language is all over the place. This is a very case-specific type of analysis.
Right.
But look at your plan doc. The more detail you have in relation to this, probably the worse off you are when it comes to what's payable and not payable.
And one last thing before I turn over to Jen for plan docs is to say, also beware of other parts of the stop-loss policy when you're looking for gaps and interpretation issues. You could have a provision in the stop-loss policy where the carrier basically says, we won't show you any deference, or, we will show you deference. So read the entire policy, and you'll be better off detecting whether or not you have a gap with your plan and your stop-loss policy. Jen?
All right. Imagine this. There's a situation where an employer has made the smart decision to move from fully insured to self-funded. They're amped. They're so excited, but they're not in the business of health insurance. So they reach out to their administrator and they say, I need some help here. I need you to craft me a plan document that's going to include all the best practices, industry standards of what you think are going to be the best. TPA says, or administrator says, not a problem. I'm going to work internally to do this, or I'm going to work with an outside vendor and get this taken care of for you. A document is drafted, a compliant SPD. It has all the cost-containing procedures, provisions, all of the best practices rolled into this beautiful document. The entity, whether it's the TPA or another vendor, presents this document to the employer. The employer gets this email that has a 150-page plan document. They say, oh, geez. Just as immediately as they hit send on the receipt of the actual plan document, there is an executed signed copy of that plan document back at the TPA's inbox. It's like they didn't read it, right? Turns out, a couple months later, there's a situation where the employer is faced with a situation for maybe a therapy claim, or maybe there's a particular situation for infertility benefits, and the claims are denied because based on the industry standards or the best practices, those types of claims are not covered under a standard self-funded plan. Maybe they were required under a fully insured policy, but not the self-funded plan. Claims are denied. Or maybe there's a situation where it's covered in the plan, but the stop loss isn't taking a look at it. Who's at fault? Is that the drafter of the plan for not realizing that under the fully insured policy they should have covered a different benefit? Or is it the employer's fault because maybe they should have actually read the document before they signed off on it?
I say it's the employer. They have the fiduciary duty to be prudent with plan assets. They have the fiduciary duty to protect their rights of their employees. They have the duty to read the plan. Now, could they say that you have a duty, whoever it is, plan drafter, to draft and create a perfect document and you agree to take on liability? Again, that's a separate contractual issue, right? They could have a deal where the drafter, if there's a mistake, the drafter is responsible for fixing the mistakes. We're getting questions in regards to other services out there like Think HR, et cetera. Again, folks, we're not here to bash or say anything good about other people. All I know is we have people that can write plan docs. Have us write the plan. Or have us help you write the plan. But at the end of the day, before anyone signs anything, I think it's just a good idea to read it. That's the bottom line. So if you're the employer, read the actual plan document, because otherwise they're going to blame the administrator, they're going to blame the broker, they're going to blame the stop loss carrier, they're going to blame the drafter. We all know that. But I think if we have something that says you agree to review this and then sign off on it, that's probably the best way to go.
That's the importance of having that adoption and sign-off page within the plan document. And even more than that, taking this one step further, what's going to happen if the employer, instead of actually immediately signing and executing that plan document, the compliant, beautiful plan document upon receipt, they sit on it and they wait. And that way, claims are coming in, and the claims processor, the TPA, doesn't have a signed document to use to process claims. Whose fault is it at that point? What basis are they using to actually process these claims? So either way, that is a discussion that needs to happen with the employer where they understand the obligations of using or immediately signing a plan document or using an unsigned plan document. All right, let's switch gears a little bit and talk about some auditing. Okay, so there is another situation where say that there is a self-funded plan and they're working with the administrator who has a really great arrangement with a certain network. So when they're drafting their actual plan, they make sure to include this really specific and particular language about how to access the network for certain in-network claims. This particular language that must be there. A claim comes in, and the plan sponsor says, geez Louise, this is a really high-cost claim. I think that I'm going to have this audited just to make sure this is appropriate. So the claims get sent off to an auditor, and the auditor says, yeah, you're right, maybe a third of these claims should be payable based on all of these very specified parameters. So then the employer, the self-funded plan, decides to use the auditor's report and pay claims based on the audit amount as opposed to what that network allowed them to pay for. The plan gets sued. Who's at fault? Is it the plan's fault because they made the decision to pay based on an audit? Is it the TPA's fault because they're the ones that hooked them up with this network arrangement? Is it the auditor's fault because they didn't agree with the PPO network rate?
We see this all the time. And the number one reason we see this is because the auditors come back, they do all these audits, and then Phia, we are asked to go and recoup the money. And what I can tell you is we have been very hard-pressed to find a really good audit firm that is giving us real, valid reasons for the overpayment. And a lot of times we'll say, yeah, but it's above UNC. So 80% of the time they're telling us that the claim was overpaid because it's above UNC. It doesn't matter if it's above UNC. It's an in-network PPO claim. So that's, again, if I'm an auditor, I want to look good, I'm going to come in and find a lot of mistakes. But for the company that actually makes money like we do, only on when we actually can recoup the money, we're a lot tighter in regards to what we say is recoverable, what really is an overpayment. Right. Which, by the way, just so you know, in our same survey, the reason why many of our clients don't pursue these kinds of situations, one is because they don't want to get blamed, that's one. But two, a lot of TPAs feel, 65% of them actually, feel it makes them look negligent. So an auditor will come in and make that TPA look negligent because they're overpaying claims that are in-network. You're paying the DRG rate. Yeah, that's what you agreed to in the network contract. Well, I didn't know all of what I was signing. Read the contract. So again, a lot of finger pointing, but I think you know my opinion on this one.
And I think actually, Adam, that leads in very well into the next slide. which has to do also with the PPO network. And it's interesting because I was looking at the survey results, Adam, that you've talked about a couple times now, where our clients who were asked the question, where do you need a refresher? Where do you think more attention needs to be spent? And something like 60% of them responded that they want to know more about reference-based pricing, but only 16%, that's a 16%, said that they want to learn about PPO contracts and reviewing the PPO contract language. How can you be interested in reference-based pricing and using reference-based pricing, using Medicare-based pricing to reprice your claims if you don't know how to review your PPO contract first? And that's exactly what you were just talking about, which is anybody can come in and reprice the claims based on any number of parameters. But if you have a pre-existing arrangement, a pre-existing condition, a pre-existing contract that limits or prohibits you from using the results of that audit, then it's not worth the paper it's written on. So for that 16% that said they want to learn more about reviewing PPO contracts, good for you. For the rest, you're not allowed to learn about reference-based pricing until you first know how to read your contracts and make sure it's allowed in the first place. Now, when you talk about people pointing fingers in the blame game, the issue that we're starting to see now is a claim is paid, it's paid at a network rate, maybe stop loss gets the claim, and they go and they do their own audit like we just talked about and decide it was overpaid. And so they're not going to reimburse the amount that was actually paid, they're going to reimburse based on their repriced amount. Broker sees this, and the first knee-jerk reaction is to point the finger at the TPA and say, you screwed my client, the plan, how could you have done this? You should have known that you were paying too much here. Stop loss did the right thing, you did the wrong thing. Meanwhile, the TPA is saying, hey, look, we paid in accordance with the PPO contract, which, by the way, up until now you've loved. In fact, a lot of TPAs use these PPOs as a marketing tool to get the business in the first place, because these groups and their brokers, they say, hey, we need a really great network. And they love the network until that one big claim comes in.
Here's the bottom line, guys, and we're going to keep it really simple. It takes an hour to read all these policies. You know, I just had a call an hour ago with Brady where we were asked a question to go, hey, can you do X with ASO contracts? And we don't want to have to say it, but we're like, it depends. Not every carrier's contract is the same. Not every ASO is the same. Here's the bottom line. The plan has, and this is Ron's example, the plan has a duty to audit the claim. The plan has a duty. They're breaching their fiduciary duty if they don't audit claims.
Mm-hmm.
So they have the right to. The broker is just doing it because the plan wants them to do it. They don't have a right to do it. The plan does. The TPA's hands are tied because the TPA signed a network contract that then binds the plan. And that says there is no audit right. Who's to blame? Again, you're sleeping with the enemy. I mean, you make the decision to, if I want to be with this network, here's what the contract says. You know, that's why I tell people all the time when they go, oh yeah, the stop loss carrier mirrors the plan. The plan's not following the plan, typically. Mm-hmm. So the fact that you're mirroring the plan, so what? So we're getting questions all the time, and this is one of the questions we got. You know, can you help us? We have a stop loss carrier that wants to cut a claim to R&C that we paid at the network rate. Call us. But we see it every single day. Why? Because the stop loss policy carrier has language in the plan, in the policy, allowing them to pay the claim at R&C. So what you should have done, if you had a great broker, your broker would have said, hey, you see this provision there? Take it out. Or on page 1 of the stop loss policy, there's a comment section. You as the plan or the TPA can say, you know what? Here's what we're going to put in that comment section, a little star, a little asterisk, and it's going to say, FYI, all in-network claims will be paid based on the in-network rate. You just saved the call to Phia. So I shouldn't have probably done that.
No, definitely not. The last thing I'll say on this slide, and I believe this actually came up in a case, I can't remember off the top of my head, I know it was a tribal plan. I would say who's to blame also has a lot to do with what's in the plan document. In that case, the plan had basically told their TPA, we don't want to use your network. Treat every claim as out of network. The plan document indicated reference-based pricing was the way they wanted to price claims. So think about it. In that situation, they told the TPA not to use the network, and the TPA applied the network anyway. In that instance, easy finger point at the TPA. If it's not that clear, well, then I think it's a lot more dubious. Adam?
So the next one on overpayments is pretty simple. We talked about it, right? Who's to blame? It depends on the overpayment. When a lot of times, in my belief, and again, we have big proponents of the TPA industry, I believe that TPAs get a bad rap on overpayments because you're actually doing more than what the typical carrier or broker is going to do in a given situation. So you're finding stuff after the fact that probably there's no way you would have found out before the fact. So, for example, surrogacy. We love that one, right? If you found out that you paid a delivery of a child to a surrogate after the fact, it's not because you're negligent. No one assumes that a surrogate is carrying, there's a baby, the surrogate is the one that's carrying the baby. Until after the fact, you happen to see a note in a medical record that says the word surrogate on page 25. And then you go, hey, we found this mistake. Let's get this money back. You should be commended for that, not looked upon as I'm negligent for making a mistake in paying this claim. It's one thing, and we have people bring up these examples, what about overpayments where they pay for the same bill twice? Yeah, that's a different type of blame. That is processing. You pay the same bill twice. You applied the wrong deductible. We see that all the time, right? So at the end of the day, it is our belief that 80% of the overpayments are not related to negligence. They're related particularly to the fact the claim was payable, you found information out, you were able to do some due diligence after the fact, and were able to then try to recoup those funds. That, I think, is something you should be commended for. You should highlight, you should put glitter on it and go, hey, we're doing this on behalf of our employee benefit plans, instead of trying to hide it under a rock.
Yeah, and in some instances, Adam, the law actually requires you to investigate fraud and misrepresentation. So overpayments are a natural result of that legal obligation. Now, speaking of what the plan document says, who's to blame, when, where, how, the Macy's case is a great example where I've mentioned that tribal case before where the plan explicitly said, we don't use a network, we use reference-based pricing, and then their TPA went and just applied the same network to them that they applied to everything else. That was obviously the TPA's fault. In this instance, Macy's basically said, hey, we want to start using reference-based pricing, but they never actually changed the plan document. They never implemented it appropriately. So unlike that tribal case where the TPA totally ignored the instruction, in this case, the plan document didn't actually support the plan instruction down the line. So the problem becomes, one, you love using the network when it serves you, but now you're going to try something different and you haven't fully implemented it. Of course, then the plan's going to say, well, we told you what we want to do. Why didn't you tell us what we need to do in order to make it happen? So again, this is just a matter of not clearly explaining what the intent is and what needs to be done in order to execute the intent. The next case here, which is the STISO case versus International Steel, basically in this instance, this is, again, bad plan language. It's funny, I feel like everything is ultimately leading to you having good plan language.
It's ultimately leading to you calling Jen Thursday or Friday, asking her to write your plan.
I didn't say it, Jen, that was Adam. So in this instance, what happened was the summary plan and the full plan document, especially a long-term disability plan, but the same rule applies to health benefit plans as well. In this instance, the language indicated that there was a 7% increase in benefits year after year for the cost of living. So when this gentleman who was on long-term disability tried to enforce this and get his 7%, the plan came back and basically said, no, that's not what the language means. We're sorry that it's a little ambiguous, but we have the right, we have the power, the discretionary authority to interpret the terms of the plan. And when it was brought to the lower level, the court agreed, but at the next level on appeal, that higher court basically said, no, when the language is this clear, we don't defer to your interpretation. We just enforce the language as written, and so they enforce the 7% year after year growth. So moral of the story is, if the language doesn't explicitly say what you want, is it the fault of the person who wrote it? Maybe, if you tell them that they made a mistake and they need to fix it. But if you see the mistake and don't bring it up to anyone's attention, now it's your fault as well. And speaking of people who are at fault for plan document issues, I'm going to give it back to Jen.
So I'm going to cut to the chase on this one. In both of these cases, this is not actually a situation where the plan language was at fault. This is a situation where the plan was ultimately responsible as a fiduciary for making decisions, but decided to delegate some of those responsibilities to another administrator. So in both cases, you talk about Pac Steel or Pacific Shores. So in that particular case, that was a situation where there was a woman who was severely anorexic, and there were piles and piles of medical records saying that she was starving herself. There was a history of this. She was suicidal. There are a lot of very serious medical history condition indications that this individual really needed some sort of inpatient services, inpatient stays. And instead of actually taking a look at the medical records, the Pacific Shores Hospital, in this case, the relevance for what they were using to make decisions about whether or not that inpatient stay was going to be a covered service was based on phone calls and voicemails instead of the actual medical
Let's
records.
just be honest. They didn't look at the medical records and make it a claim decision. When I look at the medical records, it's idiotic. So my favorite line on this one is that we hired TPAs on the call. Listen to this. They actually said, yeah, well, we hired TPA to do the hard stuff.
Mm-hmm.
I mean, really?
Right. So that is not negating your responsibility as a plan sponsor
You're very nice about
to
this.
make
Super nice.
to make the decision about whether or not something is medically necessary. And the same situation actually happened in this Shaw case. People are relying on phone messages, voicemails. That should not be the basis for making a decision about whether or not something is medically necessary.
And the same person making the claim decisions. Lisa, your claims manager, should not do your initial review of a claim, the appeal of a claim, the final level appeal of a claim as well. Also, not all IROs are equal.
Right.
We have seen IROs write medical reviews that are 3 pages long and others that are 30 pages long. There's a difference.
Right. Outsourcing that responsibility to have somebody else provide you a medical determination,
Call Phia.
right, isn't going to absorb you from any sort of responsibility when it comes to being the potential fiduciary in that claim.
Look, you also don't want to hire Lisa to be your broker either, because in this example, the case of Johnson and Towers versus Corporate Synergies, a few years back, this case was handed down. But basically what you had here was an SBD had an amendment which it allowed coverage for widowed spouses of the group shareholders. The broker in this case placed stop loss with the plan and forgot somehow to provide that amendment to the carrier when they were doing underwriting. So, of course, what do you think happens? It's exactly what happened. One widow in this case, a widowed spouse in this case, incurred $380,000 or so in claims. Stop loss denied amounts over spec. In that case, it was $125,000. They said the widowed spouse wasn't eligible. Why? Because they didn't know about this amendment that was never provided to them. In that case, the court actually found the broker to have had a fiduciary duty, found him liable. So the takeaways there are third parties, as we know, can be considered fiduciaries. This is plans hire brokers, so this doesn't happen. Big mistake. And to protect yourself from liability in this case, even though you can't disclaim fiduciary liability, once you have stop loss placed, you can take steps, and we have an addendum that we offer as part of our ASA disclaimer, which protects TPAs in certain cases, but just know that those kinds of mistakes are a big problem.
All right, so this next case, I like this one a lot because we unfortunately see this situation come up all the time. In this instance, Cigna was providing ASO services for the Crittenden Hospital Association.
We see this all the time.
And they told the plan participants these claims were coming in, and the plan sponsor was underfunding or not funding the plan. And this didn't go on for weeks or months. It went on for years. And the providers, the patients, they were saying, hey, I'm getting these bills. Is everything cool? And the ASO basically told them, yeah, everything's cool. Don't worry about it. And in the meantime, they're losing their discounts. They're losing opportunities to negotiate with these providers. Maybe if the patient and the TPA had gone to the provider and said, hey, we're really sorry the plan is underfunded. What can we do to negotiate the bill down since the patient has to pay out of pocket? Those opportunities were lost during this administrative juggling that was going on and passing the hot potato.
So Ron brought up the next point before we go to the next slide, and that's the TPA. What should the TPA do in this situation? It's not an easy answer. I know right now that we have at least 30 TPAs, minimum, who have told us, have contacted us, said, hey, we got a plan that typically doesn't pay on time. Right? We float the money. We're paying it for them. They're a really important client. We don't want to screw them over. We want to keep them around. But they're literally paying claims without the plan's money. They're doing it on their behalf. They're not telling members. They're probably telling the members they're fine. And, this is a typical scenario that we see where people are trying to keep their business, help their business, but not necessarily doing what's quote-unquote legal.
And at the risk of promoting another Phia awesome service, people will ask, well, what am I required to do? In most instances, the only thing you're required to do is what your administrative services agreement says you're required to do. And we actually have a template administrative services agreement here at the Phia Group that covers this exact issue.
Hey, Ron, before you get into this last slide about Connecticut, I want to make sure we do a kudos and a shout-out to our friends in Connecticut at Diversified Group, who won the prestigious 2018 Empowered Plans by Phia Award. I want to say to Brooksy, Charlie, and the folks down there in Fallensby, congratulations. You guys are well-deserved. You guys truly do care about your clients' money and their assets. So, job well done. Ron?
It's funny you mentioned that. Speaking of Diversified, they're frequently dealing with a lot of the legislative and regulatory things that the state of Connecticut are trying to do. And this is just one example where basically the bulletin explaining self-funding as they were looking to hyper-regulate self-funding in Connecticut, one of the things they mentioned, and again, this was 2015, and thanks to our friends in Connecticut for pushing back on things like this, they actually said that a self-funded employer is legally responsible to pay for claims under the plan, but may be financially unable to fulfill its fiduciary obligations, or I agree, sometimes that could happen if they're underfunded, like that last slide, due to the limitations found in the stop-loss policy.
Wow.
Basically what they're saying is that if you can't pay the claim, it's because stop-loss isn't giving you the money. They're one of these states that are basically saying stop-loss is health insurance, and this is the attitude that we need to push back against.
Big brother state, like, you got to be careful what you sign. That's why we tell people all the time, when we see these stop-loss policies coming in, these MGU policies coming in that are really poorly written, it actually potentially hurts our self-funded industry because it gives states like Connecticut and other states like them, you know, basically power to show, look at this policy. How dare someone issue this policy? This is ridiculous. No one's going to pay claims. It makes sense.
And while I want to point the finger at the government, you know, I also point the finger at, remember, if you're issuing advanced funding, level funding, anything where the group may be more dependent on you fronting money in order to afford the plan, just be aware, let them know the limitations of the plan so that you don't end up dealing with something like this.
So typically every month we do a shout out to someone. So this month's a little different. I want to do a quick shout out to a gentleman by the name of Joseph A. Luquette Jr., who passed away on June 6th. For those of you who don't know, Joe Luquette was a top executive at Gilsbar. Gilsbar is basically Fia's, I think, second or third client ever. So Joe Luquette, in his 60s, made a really crazy decision to decide to give our company, Phia Group, it was three of us at the time, an opportunity to service a 100,000 life TPA. The bottom line is this: without Joe taking a chance on Phia, it would have been very easy for him to go with somebody else and not take a chance on us. I truly believe that if he didn't do what he did, he also made us hire a woman by the name of Mary Burkhalter. He said, if you want the business, you have to hire this woman. I said, okay, no idea who she was. Mary's been working for us now for 17 years. Her family is my family. They come visit me in Boston all the time. They're like our family down there. But I just want to make sure that everyone knew how special Joe, how special you were to myself, to Mike Bronco, and the rest of the Phia people here. I honestly believe that we wouldn't have a company today if you didn't do what you did many, many years ago. So I just want his family, who I know aren't listening right now, they're at his, you know, his celebration of his life right now at his funeral. But I want those of you at Gilsbar who are listening to know that he was a great man who's terribly missed up here in Boston. On that note, I want to make sure you join us for our next webinar, July 12th, 1 o'clock. We're not sure what it's going to be about, but we have a feeling association health plans might be a part of it. So if you want to get in on the game for 2019, you might want to dial in. On behalf of Ron Peck, Jen McCormick, Brady Bizzaro, and myself, your host, co-host, Adam Russo, thanks. See you in a couple weeks.